Good morning, peoples. Let's jump in here on Coin and Cony. What a mess. I mean, we've been going down, 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 and also there's a real anomaly here. I'll have to explain it to you with a lot of detail, but I'll try to move through it. All right, so there's been a plethora of trades, all kinds of things going on. We had Declaration Day. Then we had ex-dividend day, right? And then on Monday we have payday. So we all know what we're going to get paid. But as you know, Bitcoin's been going down, Coinbase, MicroStrategy, and then obviously our Misty and Cony. But I'm talking Cony now. So we're down to 1134, down 15.12%. Now, you all know that or about half of that is the $1.04 that's being paid that gets subtracted on 9/6, which is ex-dividend date, right? So the underlying was down 7.73. So that's why I say about half. And I imagine we just about matched that. Now, something very interesting. You guys are probably aware that Yieldmax filed in their new offerings, some new single stock offerings. For instance, TSMY. They filed where they can do more things with options with the newer funds. I think it may affect all new rollouts, right? So they've rolled out Airbnb, they've rolled out TSMY, and they have many more that they file for. What I didn't think it involved was the existing funds. But this anomaly, I haven't done Misty yet, but this anomaly with Cony makes me think that some of the trades that they just put on, in fact, are bear call spreads. So and let me explain. So what's been happening, again, I could be wrong, but it doesn't make sense with the sheet that they gave us for their interdays. First off, they skipped Thursday 9/5. They didn't give any interdays, right? So there were some that we didn't really know what they sold. Well, some of them they sold on 9/5, and then they came along and we got the stats on 9/6. But look at these stats on 9/6, and I'll show you what I mean. So they closed out 1,475 contracts. That's normal, right? So you close out something, I mean, they're way down at 147. So why do you want to keep a 195? You don't. But look how much it hurts you. You sell the call that you bought for 278 and you buy to close the put for 49, right? Because when you wrote that, it probably was around 170, 180. And when you drop, you lose money on your synthetic. So they closed that out. And then they closed an equal amount of their 190 for 15 cents. That's not the problem, right? So I show the 1475 at 15 cents. But what they're doing is they have some other buys that don't make any sense, right? Normally they sell short on just calls unless it's part of a synthetic, and then you always have a matching pair, right? And the synthetics are way out. The weeklies are all 913. So on these 913s, we have a bunch of transactions. Well, all you ever do in Yieldmax with your weekly calls, which are all the 913s. We don't have any 913 synthetic. Okay. So what they're doing normally is they sell short on a weekly call, and then they buy to close, which they have some of those, but they also have some buys, and they have one here on the 12-1, and they have one on the 5,000. And so what that says to me is they're putting on a bear call spread. Now, without getting into all the detail of what it is, I'll just say to you, it's a good thing ultimately. I don't know if this is the time to do it or not, but let me just give you a quick dialogue. So, one of the problems with the synthetic structure, the synthetic structure is buy a call, sell a put, both bullish bets. Okay, so you want your underlying to go up. Everybody always says if you're bullish on Coinbase, then go into Cony, right? An income fund. So, how do they generate income? Well, they go long by buying a call and selling a put. So if that stock turns down on you, you're going to lose money, but it's no different than just buying the underlying and it drops, right? You're going to lose money. So one of the ways that they generate income on the weekly basis or attempt to do it is sell what's known as a naked call. They call it a covered call strategy. Well, when you don't really own the underlying stock, you only own a synthetic and you're long via options, they can refer to selling that naked call as a covered call strategy, but technically it's nothing more than a naked call. You don't own the underlying stock. So you always have to buy it back, okay, or sell it for a profit, right? And the way you really sell it for a product is you already sold it, right? So you sold it and you just hope to keep all that income. You only have to buy it back when the stock rises above the call price that you sold it at. So let's say coin was 150 and you wrote a 155 call and got $6. Well, you're good as long as it doesn't go above 155. And then when it does, that's referred to as being capped. So then you start losing money, right? So you always want those calls to stay in the money or not go out of money, not get run by because you lose money. And then you can lose a lot of money. You start wiping out most of your synthetic gains if the underlying moves up. So one of the things Yieldmax has been thinking about, hey, everybody, in a bear market or when the market's going down, we lose money. But now when the market's going up and it roars up with the underlying, then we get destroyed sometimes and we don't make much money. Everybody said, I don't understand. The underlying's going up, and all the pundits, all the people that don't even like the income funds, they go, well, yeah, you're capped. You can never make any money. Well, you can, but it always has to be optimally when you don't go above the strike price that they write the call for, which sometimes they get very conservative and they go out 2, 3, 4%, and the thing runs up 10%, and then you don't make any money at all. Even though the underlying went up, so your long synthetic is what they call it, the combination of the call and the put, made money, but you lost a lot of it because you got so capped on your weekly call. So one of the strategies to get around that so you don't get capped is to do what's known as bull call spreads. So you buy something at a low strike price and sell something at a much higher strike price. So you're trying to get the spread so you limit your loss, right? Because on a capped stock, if for instance, we go back to the scenario, let's say Coinbase is 150 and we're long on the synthetic, right? And let's say Coinbase runs up to 180 in a week. It's like, yay, right? If you own Coinbase, it's fabulous, right? You made $30 on $150. But if you're in Cony and it was 150 and they wrote a 155 or a 157 what they call a covered call strategy. It's basically this weekly naked call, and it goes to 180. Oh my gosh, they sold it for $7. They got to buy it back for 30. So you just wiped out 90% of all your synthetic gain. And so that's happening more and more with the increased volatility in the market. They get slammed down, they run up, they get slammed down. So the income funds are having a harder time. And so there's two things involved with going to a call spread. Okay, and you refer to call spreads bearish or bullish, right? If you think the underlying is going to go up a lot, so there's a benefit and there's an issue with it, right? Like all things, right? The yin and the yang. So the benefit is you don't have large losses when you put on a call spread, for instance, or a bull call spread or a bear call spread. One's betting it goes down, the other's betting it's going up, and they're both playing calls at different strike prices, right? So one is involved in selling the first one and buying the second one, the bull. The bear is selling the first one and buying the higher one, but they're both on the same underlying at the same expiration. They just totally use a different strike price. And so the good news is you don't get capped. You never go past what you invested. You can lose all the money that you spent on that bull call spread or bear call spread, but you can't lose any more. Whereas today, in the synthetic covered call, the weekly naked call, I call it, you collect some money. Right, great, I got this money, but your liability can be 3 and 4 and 5 times what you collected. A successful week is you collected 50%, 70%, 98% of that weekly call, right? That's great. It's just money, especially if the underlying was moving up and you made some money on your strike. But if it moves way up, then you got killed, okay? So the reason I say this is that's the only explanation for what I'm seeing here, but I didn't understand that coin was eligible through Cony for doing call spreads. In this case, they're bearish call spreads, which probably isn't a bad idea because I kind of think the market goes down next week, and it's been going down, right? Especially in crypto. I mean, these things have just been going down. So if the market continues to go down next week, and we're seeing the VIX spike. I've been in calls on the VIX since last Thursday and Friday, and making a lot of money on that. And I think that continues on Monday. We can get a real spike on the VIX on Monday. But besides all that, these appear to be bear call spreads. So we could make out okay on that, but they've never said that they could do them on the older funds. And they don't label them that way, but effectively that's what that is, right? They're selling at this lower strike price. They're selling short, and then they're buying, same expiration, 9/13, right? Same quantity. You always got to keep your quantity the same, right? So now you're seeing a sell short and a buy. So that's a bull call spread. So it's the only way I want to tell you. So sorry about the long, but how else do I tell you that this is weird right now, but a little bit exciting? Here's the one downside to it, guys. As an income fund, you're not going to make as much traditionally in this. You limit your loss, but you also define your gain. Your gain is the $10 between the strike prices, right? But that's okay. If you get $10 on that, that's pretty cool if you're successful. So it's okay. Definitely okay. So that appears, that's a big FYI. And I bet I'm right. Otherwise, it just makes absolutely no sense whatsoever. So it appears that here we go with the spread. I've been watching TSMY, although I haven't been reporting on it, but like through Wednesday or Thursday, well, they didn't have an intraday on Thursday, but through Wednesday, it hadn't done any call spreads, and it's one of the new funds that could do it. Remember, they have the optionality, no pun intended, to do whatever methodology in options that they want to. They can put on a collar, they can put on some of these other techniques and options. All right, guys. So I sorry about the long litany, but I think it's important, and it could really help them with an ugly September. Now we may, after the 18th, get the bounce. I have a feeling the market goes down into the 18th. The Fed does its 50 basis point cut. We go up for 2 or 3 weeks, and then we could go down for a couple more months, because over 50% of the time that the rate cut starts, especially when they're late, the market sells off. But since I think we're selling off going into the rate cut, I think we get a 2 or 3 week bounce out of it, like another relief rally, and then we continuing to sell off, probably go back to the levels that we're very likely to go down. Now, if the reverse happens and we rally next week right into the 18th and get the 50 basis point, I think that's for sure now. Then I think we sell off hard after the announcement. But I think if we sell off next week and into Wednesday and they do the 50 basis point, then I think we get a little relief rally for a while. All right, guys, but October is also a dangerous month. Sorry to belabor all of this. So let me just tell you where Cony is, right? Without doing all my normal, because these call spreads kind of change a lot of it. Let's go here to the one synthetic that they pull back on. Well, that was ugly, right? 278 they bought the call for. And they've got a lot more contracts. They've still got 27,000 contracts. So they just took 1475 off, and that cost them 6.8 million. You see it right here now in September, right? Because on Friday I started accruing the September numbers. So they start out with a 6.873 million loss. However, they collected a bunch of money on the weeklies, but some of it's confused in the call spreads. But so far, I've got them 19 cents and 2 cents, really, the first day of accounting into the month. Now, I'm never quite sure when Yieldmax does its accounting. They may do calendar first day. I've been doing accounting at the declaration date. So I show all these values, declaration date to declaration date, but it's all going to average out here. It's not radically going to affect payouts and that kind of stuff. So the good news is we have a little bit of income. However, the bad news is look at the synthetic. Oh my God. 143 million. Now, that's only $3 because this fund has so many shares, right? So where do we close? $11.34 fair value. I know, peoples, that's low. 11.31, right? I've been out of it for a while. Now, I didn't own fiat. I should have, but I felt like it was going to get really capped. Based on what they're paying, doesn't look like they got that capped, because clearly you can get capped on the downside. Now, if they turn and do these spreads, that might be interesting. But in general, you yield less money in the spreads, but not in a highly volatile market, because you limit those big losses. Okay, so this may be the new way for Yieldmax to recover itself in time. I mean, we got to get done. I mean, I'm so bullish on Bitcoin still. Maybe it's November and it gets running. Who knows? We may go 49 here before we know it, if the markets get ugly, and could go lower. But do I think it has 100 in it? First quarter of next year, 125,000? Absolutely. Okay, so All I wanted to show you is this is pretty ugly. 143 million, right? That is not pretty. So on the payments, you can see that's $3.30, something like that. But, it's a decent start. So very, very interesting, the FYI on the call spreads. Maybe some of you should send Yieldmax an email and ask them. Um, but I think it's, they're not going to tell you. It's just you see the trades, right? Otherwise, if you're looking at it with the eyes of a synthetic and selling a naked weekly call and buying them out to close the week, which is the only way you can settle them in the way they play the market. They can't let it expire because they're using, now I went brain dead on the name. They're using the options market where they have to electronically settle, and they pick a European option, okay, which means they never get assigned. So it's not like a normal sell a call, a naked call, and they assign you the stock. That doesn't happen. But with these spreads, you just simply buy those off, buy one back, put another one on. So they're kind of flexible. But the theory is you limit your loss and you limit how much you can make. But technically, selling a naked weekly call with a covered call strategy also limits your upside, but doesn't limit your downside because you can run by that thing and lose 4 times what they paid you. So, this is probably ultimately a better methodology. Okay, guys, that's what I got for you. Sorry for the long winded, uh, but some of you would be so confused without some of that. Okay, guys, and we're going to see a lot more of that. All right, guys, this is Bruce with Targeted Wealth Creation. I'm not a financial advisor. This is not financial advice. Have a great weekend. Bye for now.